Welcome to Breaking News to Trading Moves. We've got a really specific set of data points to go through today, and they seem to paint a pretty clear picture of a pinch point in the market.
It really is a textbook case of a bottleneck. We're looking at a situation where a shortage in one, relatively inexpensive component is causing major trouble for billion-dollar companies.
And the catalyst for all of this is the recent guidance from Microchip Technology. But this isn't just about one company having a bad quarter, is it?
No, not at all. Microchip is, well, they're acting as the canary in the coal mine here. The signal is that the entire electronics ecosystem is basically hitting a wall.
And that wall is made of memory chips.
Precisely.
Okay, so let's start with the headline numbers just so we're all on the same page. Microchip Technology, that's ticker MCHP, came out with guidance that definitely spooked a few people.
It was a clear miss. Management guided for adjusted earnings per share of about 40 cents.
And Wall Street was looking for 48 cents, so
Yeah.
not a small miss.
Right. And revenue guidance came in somewhere between 1.24 billion and 1.28 billion. The stock took a hit after hours, obviously.
Of course.
But what really matters here is the reason management gave. They didn't say, oh, nobody wants our chips. They said, our customers can't finish their products because they can't get memory.
The classic golden screw problem.
Exactly. You could have the processor, the screen, the power supply, everything. But if you're missing that one memory module, you don't have a product to sell. You just have a pile of very expensive parts.
So walk me through the logic here. If I'm a manufacturer, maybe I'm making smart thermostats and I'm just waiting on memory, why do I stop buying microchip stuff? Why not just buy it, put it on a shelf, and be ready to go when the memory shows up?
It's all about cash flow. These companies are operating at a massive scale. If you're a Dell or an HP, you're managing billions in inventory. You simply can't afford to have hundreds of millions of dollars of capital tied up in microcontrollers that are just sitting in a warehouse collecting dust while you wait for a memory shipment that could be 3 months away.
So the finance department calls down and says, turn off the taps, stop buying everything else.
They turn off the tap, they push out their orders, they call Microchip and say, don't ship it yet. So from Microchip's perspective, their order book just evaporates. And it's not because their product is bad or that demand for thermostats collapsed. It's a logjam somewhere else entirely.
And this is what creates that inventory whiplash concept you mentioned.
That's the term. Because eventually that memory supply will arrive. And when it does, the dam breaks. Suddenly that manufacturer needs all those microcontrollers they delayed. And, they need them yesterday to catch up.
So you go from 0 orders to record orders almost overnight.
That's the whiplash. But for now, we're in the quiet part. The rubber band is pulled back. So we should look at who's making money from this scarcity and who's losing while we all wait for it to snap back.
Okay, let's do it. Let's move to the winners. If memory is the bottleneck, the most obvious place to look has to be the companies that actually make the memory.
Simple supply and demand. When a commodity gets scarce, the price goes up. The companies that manufacture memory chips are absolutely seeing firmer pricing power.
And who are the main players we should be watching there?
You've got Micron, ticker MU, and Western Digital, which is ticker WDC.
MU and WDC.
Got it. These companies benefit from what's called a mix improvement. When buyers are desperate, they aren't haggling over every penny, and they're often forced to buy higher performance, higher margin memory just to get their hands on something that works. So Micron and Western Digital see their margins expand.
Okay, so that's the first layer, but let's go one step further back. If there's a shortage of memory, the solution is pretty simple. Make more memory. And to make more memory, you need the machines.
And that brings us to the semiconductor equipment sector. We call this the CapEx impulse. When memory prices spike, the memory makers suddenly find themselves with a lot of cash and a desperate need to expand capacity, so they have to go shopping for some very expensive tool.
And we're not talking about simple conveyor belts here. This is some of the most complex machinery on the planet. I see 3 names here: Applied Materials, Lam Research, and KLA.
Those are the heavyweights. And it's important to understand why they benefit, because making memory is a bit different from making a processor.
Let's break that down then. Start with Applied Materials ticker, AMAT. What is their critical role?
Applied Materials is the leader in a process called deposition. You can think of a silicon chip like a layer cake. You're building it up one microscopic layer at a time. Deposition is the process of actually putting those materials down onto the wafer.
Sort of like spreading the frosting on the cake.
A little bit, if the frosting were just a few atoms thick and you had to apply it inside a perfect vacuum. Now, with memory chips specifically, like the 3D NAND storage in your phone, you're stacking hundreds of these layers vertically. It's like building a skyscraper. If you need to make more memory, you need more deposition chambers. You can't just run the old ones faster, you need more of them.
So Applied Materials sells more machines. Okay. What about Lam Research, ticker LRCX?
Lam is the master of etching. So if Applied Materials puts the material down, Lam Research carves it into the right shape. They use these highly reactive gases to chemically cut away the parts you don't want, leaving behind the circuit patterns.
And I'd imagine that as memory chips get taller and more dense, that carving process gets a lot harder.
It gets exponentially harder. Imagine trying to drill a perfectly straight hole through a 100-story building all the way to the basement without bumping the walls. That's what Lam's tools are doing, but at a nanoscale. As memory gets more complex, the etch intensity, the amount of time the wafer has to spend inside Lam's machines, goes up.
So if there's a shortage, Micron can't just flip a switch. They have to order these new machines from Applied and Lam. What's the lead time on something like that?
And that's the kicker. It can be 6 to 9 months, sometimes even a year.
Wow. So the solution to the problem lags way behind the problem itself.
Which means this spending cycle for the equipment makers could last for a while. They're booking orders today that they won't even ship until next year.
And the third one here is KLA, ticker KLAC. They do metrology.
Metrology is just a fancy word for measuring, but in this context, it's all about inspection. When you're building these incredibly complex 3D memory towers, if you make a tiny mistake on layer 50 and you don't catch it until layer 100, you've just ruined the entire chip. KLA provides the optical systems that scan the wafer to find defects during the manufacturing process.
So in a shortage, your yield is everything. You can't afford to throw away bad chips.
Every single chip you save is pure profit. So the memory makers spend a lot on KLA's tools to make sure their manufacturing yield is as high as it can possibly be.
There's one more category of winners here that's less about manufacturing and more about logistics: the distributors.
Right. When parts are easy to find, you can just call the manufacturer. But when they're hard to find, you need a distributor who might have some inventory sitting on a shelf, or maybe has special allocation rights from the factory.
They become the problem solvers.
And they gain bargaining power. They can charge a premium for what they call value-added sourcing, which is a polite way of saying finding the part that nobody else can find.
And the tickers for those.
You're looking at Avnet, that's AVT, and Arrow Electronics, ticker ARW.
Okay, so winners.
Yeah.
Memory makers, tool builders, and distributors. Now we have to flip the coin. Who gets hurt by this?
Well, we started with the first category of losers, the embedded and industrial chip suppliers. This is where Microchip Technology lives.
Ticker MCHP.
Correct. But it's not just them. This affects the whole analog embedded space. You should be watching Texas Instruments, ticker TXN, and also Analog Devices, ticker ADI.
TXN and ADI. And this all goes back to that air pocket you talked about. Their customers just hit pause on all new orders.
It creates a gap in their revenue. Even if the demand is still there long term, the current quarter can look terrible just because the shipments are frozen.
Now let's talk about the companies we all know, the ones we buy products from, the OEMs, the original equipment manufacturers.
The brands on the box. Dell Technologies, ticker DELLHP, which is HPQ, and even Apple, AAPL.
If they can't get memory, they can't sell a laptop. That part's pretty obvious. But the financial damage seems to be a little more complex than just lost sales.
Oh, it hits their margins in a really nasty way. First, you get a promotional environment. If you can't build your flagship high-end laptop because you're missing the high-speed memory, you might try to push your lower-end models harder just to keep some revenue coming in.
So you're selling cheaper stuff, which means less profit on each unit.
We call that negative mix. You're selling the same number of boxes, but they're the less profitable ones. But the bigger problem is usually inefficient logistics. When parts are showing up sporadically, you might have to air freight components to the factory at the last minute to meet a deadline instead of using a cheap cargo ship. Or you have to pay workers overtime to rush a build once the memory finally arrives. All those little operational costs just eat away at your margin.
Speaking of factories, that leads us to the final group of losers here. The EMS providers.
The electronics manufacturing services companies, these are the guys who actually own the assembly lines. They build the gear for the OEMs.
And the checkers.
Think Jabil, that's JBL, and Sanmina, SANM.
Their whole business model is built on volume, isn't it?
It's built entirely on utilization, keeping the machines running 24/7. These factories have massive fixed costs. The building, the power, the specialized labor. If an assembly line is running at 90% capacity, they're making good money. If that drops to 70% because Dell called and said hold production, no memory, their profitability just falls off a cliff.
Because they still have to pay for the building and all the workers?
Exactly. It's called fixed cost absorption. When the volume drops, the cost for each unit skyrockets. So Jabil and Sanmina get a double hit, lower revenue because they aren't shipping, and much lower margins because their factories are running inefficiently.
It really does highlight how fragile the modern supply chain is. It's designed for perfect conditions, not for these kinds of hiccups.
One single missing part throws the entire equation out of balance.
Okay, we've laid out the headline, the winners and the losers, so let's talk strategy. If I'm an investor or a trader looking at this situation, what am I monitoring? How do I frame this?
You need to put on your detective hat here. There are 3 specific things to watch. First, watch the memory pricing commentary.
Coming from the memory companies themselves, like Micron.
Yes. Listen to their earnings calls. Is the shortage language getting more intense? Or is it starting to fade? If they start saying supply is normalizing, that's your signal the trade is flipping. The winners might start to cool off, and the losers could start to recover.
Okay, watch the language on shortages. What's number 2?
You need to track the OEM shipment commentary, specifically for PCs and phones. Look for what they call build plan resets.
A build plan reset, what's that?
It's when a company like Dell or HP says, we originally planned to build 10 million units this quarter, but now we're only going to build 8 million. If you see those numbers coming down, it confirms the bottleneck is real and it's hurting volumes.
And the third thing?
You have to look for read-throughs from other analog names about their backlog. But, and this is a big but, you have to be very careful. You have to be aware of double ordering.
Explain what that is.
Okay, imagine you're a buyer for HP. You need 10,000 memory chips. You call Micron, and they tell you they can only give you 5,000, so what do?
I'd call another supplier.
Right. You call Western Digital, and you order 10,000 from them, too, just hoping you can get something.
So now there are orders for 20,000 chips in the system, but the real demand is still only 10,000.
Exactly. This creates what we call a phantom backlog. It makes the demand look incredibly high. But the second that supply normalizes, the moment Micron calls and says, okay, here are your chips, that buyer immediately cancels the order with Western Digital.
And the backlog just vanishes overnight.
We've seen it happen in almost every single cycle. So if you're listening to an earnings call from Texas Instruments or Microchip, you need to pay very close attention to their cancellation rates. If they say backlog is being rescheduled, that's fine. That's a delay. If they start saying we are seeing cancellations, that means the phantom orders are disappearing.
That is a critical distinction. A delay means the revenue comes later.
Right.
A cancellation means it's just gone.
It's gone forever. And right now, the news from Microchip Technology suggests this is mostly a delay, an air pocket. But you have to watch closely to make sure it doesn't become something worse.
So if we see cancellations start to spike, that's the signal that the shortage is ending. And maybe we're even heading for a glut.
That is the signal to maybe take profits on the memory stocks and start looking at those beaten down OEMs again. The pendulum always swings back. The cure for high prices is high prices.
The market corrects itself.
Always does.
We've covered a lot of ground, from a simple guidance miss at one company all the way to the atomic level engineering at Applied Materials. It's a good reminder that in this sector, you can't just watch the stock price. You really have to watch the supply chain.
The physical reality of the product always, in the end, dictates the financial reality of the stock.
That's a perfect place to leave it. And just a reminder to our listeners, this is not financial advice or buy or sell recommendations. This is purely the opinion of the author.
Please, always do your own research.
Thanks for tuning in to Breaking News Trading Moves. We'll catch you on the next one.